Most investors don't realize this. Global conflicts often look terrifying in the headlines, but historically, they barely change the market's long-term direction. It's been a week since U.S. and Israeli strikes on Iran, and the reaction in the market has actually been pretty modest. On the first day of trading after the strikes, headlines made it sound like they were sinking, but the S&P 500 fell less than 1%. The next day, it dropped more than 2% during trading, but by the close, most of that loss had already been recovered. And that's the first reminder. Short-term reactions are exactly that. Short term. Now, the real economic risk is if this conflict centers on oil. The fighting is happening near one of the world's biggest transportation corridors for oil, and any disruptions there could push prices higher. Iran has also targeted oil infrastructure in the region, adding to what analysts call perceived supply risk. But when you zoom out, history tells a calmer story. Research looking at more than 24 geopolitical shocks since World War II shows the average market drop on the first day is only about 1%, and then markets typically bottom within 18 days and recover within roughly 39. What matters far more is whether the economy is already near a recession. If it's not, markets historically move higher over the following months. The takeaway: geopolitical shocks create volatility, but they rarely change the long-term path of the market.